Hello, this is Scott, and this week we're going to be talking about the Federal Reserve System and the money supply. There are times when aggregate demand goes up and down and wiggles around what we would expect from a long-run stable equilibrium. The Federal Reserve is a central bank that controls the money supply. The money supply changes are going to have a way to influence aggregate demand. It's going to be used to help stabilize the economy, or at least that's the theory. So we'll have to talk about what money is, what money supply, how we calculate it, what it works. We're going to be talking about fractional reserve banking and the reserve ratio. People put some money in the bank and other parts of the money get lent out. We'll talk about how the Fed puts money into the economy and how they pull money out if they need to. We'll be talking about systemic risk and aggregate demand and policy. Most of the application of this will come in the next chapter. The Federal Reserve is one institution that has more control over the U.S. economy and as a result the world economy than any other institution in the world. So the Federal Reserve will talk about what it is and how they can influence aggregate demand in the short run by printing money or taking money out of the economy. For that, we'll also have to talk about what money supply is. What's the Federal Reserve? Well, the Federal Reserve is a quasi-public institution. It's tied to the U.S. government, but it's separated from the U.S. government, so that way politics won't get into it and influence the money supply. They are separate, but they are still sort of related to the government. It is a very strange institution. If you look at your money, at the U.S. dollar, you'll actually see it's a Federal Reserve note. Federal Reserve has the explicit authorization from the U.S. government to print money. So they can literally print money, or they could do it electronically. They could add money to their account and go out and buy certain assets. And when they do that, money gets introduced into the real world. We'll talk about that in more detail later on, but we call that open market operations. The Federal Reserve also has several other roles. When you write a check, they help clear the checks from one bank to another. They help regulate the various banks to make sure that they're solvent, that they are not being too risky, that when you deposit money, they'll get it out. They are the bank account for the U.S. Treasury, and most important role is they manage the U.S. money supply. So if I ask you a question, well, what is money? A lot of people immediately think of currency. They think of dollar bills and coins. Economists think of money as having their widely accepted forms of currency. They can store value, and they are sort of the yardstick of value. So you could see and understand that something that's $20 is 20 times more expensive than something that's $1, compared to if I went and said something's 3 chickens and then something else is, I don't know, 4 dozen eggs. Well, what's the ratio of chicken to eggs? Most people think of money as currency, but we actually think of it as far more than currency. Currency is the most liquid asset. Liquidity is how easily you can get to the standard means of exchange to buy goods and services. But we also have total reserves. So if I get a paycheck of $1,000 and I take $1,000 or $100 in cash and put $900 in the bank, those are reserves. They're held by the banks, and they're also held, the bank holds some money and they put more money in their bank, which is the Fed. That's the reserves. We have checkable deposits. So if I put money in my checking account and you would accept a check from me, that is another form of money. It's not as liquid as pure cash, but it is certainly a form of means of payment that is accepted. So we have savings deposits and money markets and small time deposits. And as you go further and further and further, there are more and more types of money. So as we said, currency is just coins and paper bills. It is the most liquid, and everything else is defined by it. Just a couple note, other countries actually use the US dollars as their currency because it's more stable. They at one point had their own currency, and it was not widely accepted. As we talked about inflation, a lot of these countries basically devalued their currency so much that people stopped accepting them, and they moved to the US currency because they thought that it would be more stable. Total reserves is when I put money in the bank and the bank puts money at the Federal Reserve. All of that money is done electronically. Those are called total reserves. So checkable deposits or demand deposits are where customers put money in the bank and they expect to be able to draw on that money and use it as payment very quickly. We use liquidity as a term to help describe how easily something is converted into the common form of currency. Just because something has value doesn't mean it's liquid. My house has value, but I can't use it to immediately pay off a bill. I'd have to sell the house. If I had a Pablo Picasso painting, that's valuable. But in order for me to use that as an asset, I would have to sell it, and I'd have to find someone who wants to buy that painting. We use liquidity as a way to measure some of the forms of money supply. So when we talk about money supplies, we'll talk about the monetary base, and the monetary base is what the Fed can really control. They can decide how many currency exists out in the economy. Beyond that, if people give me money, I can deposit it in my bank, and that becomes checkable deposits. And then they could lend that money out as part of a fractional reserve bank. So now the money supply is getting bigger and bigger and bigger. We call currency plus checkable deposits M1. M2 includes everything in the base and M1, and then it adds on more stuff. So it goes monetary base, M1, M2, M3, and there are dozens and dozens of monetary measures. Here's what you need to know. Whenever the bank changes the monetary base, if they increase it, it increases all of them. Whenever they drain the monetary base, it drains them all the same way. I don't really need you to know the difference between monetary base M1, M2, M3, M4. I just want you to know they all move together. And if you see different numbers, it's probably because we're measuring different monetary bases. So what's the fractional reserve banking? Well, the way banks make money is if I come and put my paycheck of $1,000 in the bank, they will hold on to a fraction of it, let's say 10%, and $900 they will lend out to someone else who will then pay interest. That interest is used to entice me to give them the $1,000, but it's also used for them to pay their staff and cover their costs and to make a profit. The idea here is fractional reserve banking allows money creation because it allows more money to exist in the economy. Now, how much the bank needs to hold on to of my $1,000 is what's called the reserve requirement, or reserve ratio. So some of this is set by the Federal Reserve. The Federal Reserve may say they need to have 8% or 10%, and in fact, it's actually a pretty crazy formula based on steps, but that's fine. Just think of it as 8%, 10%, 12%. The idea here is the more that they have to hold on to, the less they can lend out. The banks want to lend out as much money as they can because that's where they get their interest. So there's an opportunity cost for money that they're not lending out. So this reserve ratio or reserve requirement is the percentage of money that they have to hang on to. So that way when people want their money, if I deposit $1,000, I can come and get that money at any time. So they have to have enough liquidity there to pay out their customers. The money multiplier is 1 over the reserve ratio. And we'll talk about how that works in a second. But if I put the $1,000 in, then they lend it out and they have to hold on to 10% of it, they can lend out $900. The $900 gets lent out and they deposit it and they can lend out another $810. So it'll go around and around and around exponentially. So this formula, the change in money supply is equal to the money multiplier times the change in reserves. Well, the money multiplier is just 1 over the reserve ratio. So it's the exact same thing as saying the change in reserves over the reserve ratio. So if the bank has to hold 10% and I deposit $1,000, $1,000 divided by 0.10, I add $1,000 into the bank, it'll keep going around and around and around and will actually create $10,000 worth of records, or an increase of $10,000 in the money supply. The Fed controls the money supply, and they really have 3 main tools. One is open market operations, the next is the discount rate for lending, and the third is they can change the reserve requirements that the bank must hold. So the main tool the Fed has is called open market operations. And the way I think about open market is we have the Fed and then we have the rest of the world. And we have this sort of dividing line. And what we have is if the Fed wants to put more money into the world, we want more money in the world, that's an increase in money supply. How are they going to do it? They have to buy something. So something has to come out of the world and go into the Fed's balance sheet. So what they typically buy are bonds. We could do the opposite thing as well. If the Fed wanted to remove money from the money supply, they can remove money. And how would they do that? Well, their main tool is that they would sell bonds. So the buying and selling of bonds, in this case, that'd be money supply going down, can help increase or decrease the money supply. So it's worth noting that as the Fed pushes more money into the banks have several options. They could sit on that money, or they could lend it out. The number of times the bank lends out the money was the money multiplier. If the Fed buys $1,000 in bonds, that money multiplier is 10, could be increase the money supply by $10,000. The Fed can control monetary base, which will have an impact on all the other money supplies, but it's a not direct one-for-one. There's some wiggle room in here. Now, you may have heard the term after the Great Recession about quantitative easing. And the big difference between quantitative easing and changing money supply is the asset the Fed was buying and selling. So before they were buying normally short-term bonds, but with quantitative easing, they were actually buying anything to pump up the money supply. And what they were doing is buying lots of long-range bonds and long-range security. So if they're doing long-range bonds buying and selling, it's called quantitative easing or quantitative tightening. Same concept, just different asset. It's important to note that the Fed can increase or decrease the money supply by buying or selling government bonds. But the amount the money supply increases increases or decreases isn't just the change in monetary base. There's the money multiplier. The Fed, which can control the money supply, can really only control part of it, and part of it's dependent on how banks and buyers and lenders and savers respond to those changes. So sometimes you hear in the news that the Fed lowered or raised the interest rates, and we've been talking about money supply, but in effect these are exactly the same thing. So what we have is in the market, what we're going to call is the money market, which is really the market for loanable funds. We have a quantity, and the price of loans are the interest rates. Well, there's some demand for loans and money and some supply for money. Well, what the Fed is really doing is they are targeting a specific interest rate. So if this is the current interest rate, if the Fed increases the supply of money, so in other words, they're buying bonds, which pushes more money out into the banks, the supply will have gone up, which will have pushed the interest rate down, which will cause borrowers to go from this amount of loans to this amount. They're moving at a lower interest rate. People quantity demanded for loans increases. You could think of an increase in money supply as the same thing as decreasing the interest rate. The Fed really typically focuses on the short run, and we'll talk about why that is, but monetary policy is typically very fast. So they typically focus on what's called the federal funds rate, which is really the overnight lending rate that banks charge to each other. It's pretty much equivalent. If the Fed increases money supply, it's going to lower the interest rate. If they decrease the money supply, they're going to increase the interest rate. They don't have full control over M1 and M2 because the money supply is affected by how often banks lend out the money. So if you can't really manage M1 and M2, but you can see the instantaneous interest rate from your effect of increasing or decreasing monetary policy, you can get an idea of what the impact was of getting that money into the real world, into the economy. So that's why the Fed typically focuses on the interest rate, which is much more manageable than the money supply. The Fed also has what's called the discount rate, and the discount rate is the interest rate that banks pay when they have to borrow money from the Fed in order to meet their reserve requirement. So if you gave me $1,000 and I'm required to hold on 10%, at the end of the day, if I lent out more than $900, I have to get to that $100 reserve requirement. I could go to other banks to try and get that money. In fact, that's what most banks do. It's intra-bank lending back and forth. But if no one will lend to those banks, the Fed will lend to them at a certain interest rate. So this is also part of the lender of last resort. But it's very rarely used. Why is it rarely used? If other banks are refusing to lend to this bank, it's often seen as a signal that these banks are on the verge of failure. Banks hate using this discount rate in all practicality, so they try and avoid it at all costs. Let's talk real briefly about some of the problems that banks can have. One is insolvency, which is where liabilities are greater than assets. In the course of banking, I make out a bunch of loans. If I make out a bunch of loans and some of them go bad, I may not have enough value to pay back everyone else. If my liabilities are greater than the assets, I'm what's called insolvent. Then there are liquidity problems. You may have the value, but you don't have the liquid money to pay off debts when they are due. So for example, I may have a house or a Lamborghini that's worth $100,000. But if I have a credit card bill that's worth $1,000 and I have no cash, even though I have the assets, it's not liquid in order for me to pay it. That is called a liquidity problem. So during the Great Recession, there were huge amounts of bank problems in terms of liquidity and insolvency. So the Fed stepped in to try and pump up those banks in order to allow the banks to not collapse, not to cause these bank runs to be the lender of last resort, and to make sure that bridge between lending and borrowing, which is key for capital growth, didn't collapse. A third thing that the Federal Reserve started to do during the Great Recession was for the reserve requirement, when the banks gave money to the Fed to hold on to as part of the reserve requirements, they didn't get any interest on that. So the banks really had an interest to have that reserve requirement be as low as possible, because that way they could make the loans. Well, now on a $1,000 loan, have 10% reserve requirement, you have to give $100 to the Fed as bank reserves. They're now giving interest. So now it doesn't hurt as much to keep the money at the bank. The more they raise the interest on those, the less likely they are to lend it out to someone else. The lower interest they offer on those bank reserves, the greater the opportunity is to lend it to someone else who's willing to pay a higher interest rate. So the lower the interest rates on reserves, the higher the money supply. So another role of Federal Reserve is to look for systemic risk. Systemic risk is where one thing can topple the entire system, and it can have this spiral effect. When we talk about the Great Recession, one thing the Fed did, and you're not expected to know this, is that they guaranteed loans to JP Morgan that they made to Bear Stearns to prevent Bear Stearns from failing, because they thought if Bear Stearns failed, it would cause a ripple effect and due to the money multiplier and cause many other banks to fail. That makes us talk about moral hazard. Moral hazard is this idea in economics that when when someone has insurance, they're more likely to take risks and bigger risks. If you have automobile insurance, you're more likely to speed than if you didn't, because if you get into an accident, you'd only have to pay a portion of the damage rather than all of it. So when the Fed helped with the systemic risk, it created a moral hazard problem, which means that banks often will take too much risk. Think about it. We have a couple things going on here. The banks were basically insured by the Fed, so they had a safety net. The borrowers, if I deposit my money in Wells Fargo or TCF, I'm insured by FDIC, the Federal Deposit Insurance Corporation. So I don't really worry about how risky they are, because as long as I have under $250,000 in the bank account, I'm guaranteed to get my money out. Neither one of us are managing our risk completely. So how does this all work for the Fed? If the Fed wants to pump up aggregate demand, for some reason if aggregate demand is below the long run, the Fed can buy bonds. As they buy bonds, it forces money into the banks, which will then decrease interest rates. As interest rates go down, people are more likely to take out money. I'm more likely to buy that house, buy that car, buy that boat, because money just got cheaper, which will increase spending, which will push aggregate demand back up. This is the real short of why monetary policy influences aggregate demand. Graphically, how does this work? Let's say we are starting off at point A and there's aggregate spending of 5%. Given that we expect 3% to be long-run growth, we would expect about 2% inflation. If we decide to pump up aggregate demand, we increase spending by 5%. In the short run, what do we have? We have people who are responding because there's more money going around. They're a little bit confused in the beginning and saying, well, maybe my product is doing well, and they increase their output. And eventually, some of it is output and some of it is prices have gone up by a little bit. Pretty soon they realize, well, wait a second, we have 4% inflation, but we only expected 2%. We're going to have to start shifting our short-run aggregate supply, and it's going to keep shifting until all of that growth has gone up by the 5%, from 2% to 7% that we saw in the change in our aggregate spending. Because in the long run, an increase in money supply will always show up as inflation. We want to also recognize that monetary policy is really difficult. Why? Because first you have to understand, well, where is aggregate demand and how far off of this long run growth is it really? And then you have to figure out, well, how much should I increase money supply and the monetary base so that it will pump aggregate demand up? Now remember, they can influence monetary base, but not M1 or M2. Also, just because now the banks have more money doesn't mean that they're necessarily going to lend it out. So how the money multiplier impacts is outside of the control of the Fed. Also, the Fed is looking at historical or lagging indicators like interest rates, which are pretty fresh, but not always perfect. Monetary policy is really difficult. So you may be wondering who actually runs the Fed. So the Fed has a board of governors, which is 7 members. They're appointed to 14-year terms. The long 14 years is to try and shield it from political influence. There's one chairperson. If you look at the dollar bills, there are 12 regional banks. There's only one west of the Rockies in San Francisco. There's a Federal Open Market Committee that is rotated among the Federal Reserve governors, with the exception that the Federal Reserve Bank of New York is always on the Federal Open Market Operations Committee. I want you to think for a second about why it's shielded. Why do they have these 14-year terms? A lot of that has to deal with is if I was going to be president, I know that if I pump more money into the aggregate demand, that the economy is going to heat up for a little bit and we're going to see a short-term burst. In the long term, we're going to see inflation. But if I'm president, I'm worried about the short-run election. I'm not worried about the long term. If there was political influence, we'd see a lot more inflation than what we're actually seeing right now. All that being said, there's lots of people who think the Federal Reserve has just too much power. In order to be on the board, you have to be appointed by the president. You have to be confirmed by the Senate. You have these long terms, and they're often academic. Here's my 2 cents, is that these economists have done a really good job of being impartial. As much as people try and make this a political argument, in general, most of the politicians have been pretty good at leaving the Fed to be independent. Most of the politicians recognize the more influence that they push on the Fed, the harder that the Fed will have to look on the long-term issues, and they'll be focused just on the short term. And they really have to manage both. The Fed has a goal of full employment and low inflation. There's a trade-off there, one or the other. So we want to make sure that they're looking at both and not just one at the expense of the other. Okay, so this has been a really long lecture. So what do you need to know? The Fed creates money. They're in charge of the money supply. They have a big influence over aggregate demand. As a matter of fact, they're the big single largest institution that can help fluctuate aggregate demand. It's important to know what M1 and M2 are relative to monetary base, but you don't have to know exactly what composes each one. You just have to know monetary base, and then M1 includes monetary base and other stuff, and M2 is M1 and more stuff, and it keeps getting bigger and bigger and bigger. You need to know that the Fed controls the money supply by buying and selling government bonds, and that's called open market operation. You have to know that the money multiplier is how many times a new dollar in the economy gets circulated and count. Because we have a fractional reserve banking, a dollar can count for $1 for me, 90 cents for you, 81 cents for someone else, and it can multiply exponentially throughout the economy. You need to know that the Fed buying bonds is the same thing as interest rates falling. That falling interest rate influences aggregate demand, but that timing has issues. If the Fed thinks that the economy is getting too hot, it's growing too quickly, what can they do? They can take some money supply out of the economy by selling some of those bonds back. The Fed really looks at the short-term interest rate, and that's called the federal fund rate. They really don't have a lot of influence over the long-run real interest rate, and they're really the lender of last resort, and their job is to try and manage systemic risk within the banking system.